life that is used in the example in the book is 31.5 years. Now, if you should say, whenever I say 31.5 years, you should say, what? What?
39.5.
No.
31.5.
31.5 is what's used in your book.
The book,
Oh,
yeah.
I thought it was 27 and 39.
Yeah, but the
It
book
is.
uses
My point being is the book uses 31.5. The reason it uses 31.5 was because when these textbook authors originally wrote the book, the depreciation term was 31.5 years, and they haven't updated it.
So it is 39.
It is 39, or should be 39. And I updated the example to be 39. Okay? That's what happens with textbook authors. Even after 15 editions, you would think they would catch all their little, they don't.
Well, this one has a lot of mistakes.
They're,
Yeah,
you
full of it.
would think, once again, 15 editions, they would.
And the 15th was right down to the 14th.
Anyway, moving on. Okay, on the ownership side, all right. So the property value, what it's worth in today, number of years since it was purchased, 5 years. The original purchase price, $275,000. The actual breakout of the building versus the land for depreciation purposes. I think the percentage that's actually used there is maybe like 87.5. Let me just double check. Yeah, 87.5% is attributable to the building value, and then the remaining, I guess, 12.5% attributed to land value. Then you estimate whatever your resale value is going to be, and then pop in your loan-to-value ratio with respect to what you're going to be able to obtain in terms of potentially a bank loan. What the loan amount would be, and that is going to be based on, obviously, a percentage of the purchase price, which in this case, 85% of the $275,000, then your interest rate for the loan, however many years that is, and then that is going to automatically calculate what your initial equity investment is. Okay, so for the most part, none of this is really new, with the possible exception of kind of this little piece of information up there. All the rest of this you should have seen before in one form or another. Yes, sir.
So the assumption is he bought the property 5 years ago.
Yes.
At $275,000.
Yes.
Today it's worth $450,000.
Yes.
If he wants to sell, he's going to sell it for $500,000.
After year 15.
After you, okay,
Projected
resale, I see,
Which
I
I-
value you 15, gotcha.
Yep.
And so, okay, let's just do it that.
Yep. Okay.
What is that 41,250?
That is the equity. In other words,
So it's
you can-
15%?
Yes.
Okay.
So if you add the 41,250 to the 233,750, that will give you the 275.
Right. 15% of 275.
Yes. Okay. Everybody cool?
Yeah.
Okay. Now, let's go down the page.
Sorry. So the assumption is that if I want to, now I'm a retailer, I have the property, the question that I'm looking at is, do I want to refinance it, right, with that loan to value?
Well, what we're actually going to be doing, what we're going to be doing is side by side of what if we owned it, what if we leased it, what's going to be the difference in our cash flow stream.
But they already own it. Correct.
The assumption is we're looking at it as if you have a choice between the two.
Yeah, yeah. So but my
Decision
question is,
making.
okay, so my question is, why would you need the mortgage or the rates, the loan to value ratios for what, when they sell it to somebody else and then for the lease?
No. This is looking at it as if you were making this choice up front.
So you haven't bought anything, you can either buy or you can choose to lease it.
Or at some point during your ownership, you could choose to do a sale leaseback and then make the comparison. Okay? So in this particular example, what they're trying to sort of start off with is just simply saying, look, owning versus leasing is not going to change any of these first few little variables in terms of what are your sales, what are your cost of goods sold, what's your overhead, your net income off of the business. None of that's changed, okay? The operating expenses are not going to change between owning versus leasing. You're still going to have the same electric bill, so forth, so on. Okay, now, where things begin to change are basically here from lease payments down, okay? So from lease payments down, obviously, if we own it, we don't have a lease payment. Very simple. So what happens is that gets populated over here under the lease. Everybody see that? Okay? With owning it, you receive, as we had talked about earlier, the mortgage interest payment deduction. Okay? Of the $17,531. And also the tax depreciation of $61.70. Okay, so then just stopping right there, without going any further, what are we saying? In terms of taxable income, we have higher taxable income over here with owning than we do with leasing. Okay? And now, on the surface, what does that really mean to us? If we have higher taxable income, that means we've got more money coming into us, yes?
Right.
Normally, that's a good thing, yes? Okay, well, let's just see if it continues to sort of follow through. All right, so we apply the appropriate taxes. Once again, probably whatever the tax rate was, 15% for each of those respective taxable incomes. Then we get our incomes after taxes. We're still looking as a positive over here on the after-tax, so the preference for owning under that scenario. And then the depreciation. Now, this is something that you've got to kind of get into your head about depreciation. Listen to the question. Is depreciation a cash expenditure? Yes or no?
No.
No. What is it? It is an allocation that is made for the determination of taxable income. Okay? It is not an actual cash expenditure that you write a check for to someone. Okay? So, that having been said, we have subtracted it here as if it were like a cash expenditure to do a calculation to calculate our taxes. Okay? We took it out. But since we took it out up here, we've got to add it back in down here because it was not an actual cash expenditure. Okay? So it should not affect our actual cash flow. In other words, what's happening here is, yeah, this is our income after taxes, but we took out the depreciation up here, so we've got to add it in back here to get what is our real after-tax revenue. Money, hard cash money. Okay?
So what was the rationale of taking it out of?
Because it's a
139?
deduction. It's a deduction. This is a subroutine to simply calculate what is my tax liability.
Switch.
What? I didn't do anything.
Wow, active screen?
That's great. Well, it's lost, of course.
That's not a touch screen. It almost looked like
It
that.
is when you touch it.
Great. Okay. Should be.
It should probably still be hiding in Excel.
One question, Drew, was if you're trying to now own it, because they already own it, you're trying to refinance it.
Cause I just tried to go
Today is not my day. Technology is not my friend.
If you do follow recent,
Yeah, but it's not responding. It's just like it's
Oh, it's the internet.
I mean,
it's just like it's dead.
I think that's what it is.
You don't have the file on your computer?
That's what I was asking you, is it not hidden in Excel?
No, it's like Excel is pretty much locked up.
Oh,
Look, there it went. Yep.
Yeah.
Can you use somebody else?
Hold on. It'll come back in a minute.
it's just reading.
so I was trying to ask you, if I'm the
Oh,
and in the assumption it says that you're already 5 years in 5 years, So I already own it.
Right, but you're doing the analysis as of 5 years into.
Yeah, as if I was gonna like refinance.
Or-
Alright, that makes
right.
sense. You don't know the structure.
Right.
That's where I would put
Yep.
it.
But if it wasn't an interest only.
You wanna plug this one in? One south.
You're only gonna use tax the nice appreciation you get back at the end, because it's actually money. It's value.
What's the
Yeah,
size of it?
yeah.
What's the interest on your mortgage? I'm trying to figure out why.
My apologies.
No problem, sir.
Why,
Tax deduction.
But she-
never had that happen.
Tax deduction purposes, you don't take the interest rate you pay on, you know, and that's what gets deducted out of the full payment. It's only the interest.
So, I understand you don't record.
No, like what I'm saying is when you, how much deductibles, you're not, you cannot deduct the full payment, you can only deduct
So
the
this
interest
file you just
portion.
sent us, it's
Right.
all in the Excel
Right,
spreadsheet from the
that's
text book.
why I'm-
Thank you for that.
To see
Rather than that.
the numbers, what we're looking out at more.
Is there not in this, I don't know what the assumptions are.
Oh, you don't have,
No,
I knew that.
that you were asking about your money. Could be that maybe they just got interest on the loan instead of the full.
No, yeah, that's what I think he said earlier.
Yeah, so if that's the case, that's the reason, otherwise you would have that subtlety minus.
Right.
Minus the full payment.
Okay, I think we're back up. Below is back up here. See it?
Put a copy on your desktop.
No, it's weird. I should not have done. Okay, moving down the page here. Okay. All right. So, as I was saying, I'm not going to touch the screen this time. Even though it should have no connection to that. Okay. All right. So at this point, what we're saying is that our after-tax cash flow from owning is higher than our cash flow from leasing. So therefore, from that standpoint, we've got a positive net after-tax cash flow from owning of an additional $15,000. Okay, is everybody comfortable with that? Okay. Now, what we then do is we kind of go down and we take a look at what would happen if we sold it at the end of the lease term, the cash flow from the sale, and then also what it would be if we sold it today, okay? So let's look at the end of the lease term. The resale price of the $500,000 minus our mortgage balance, giving us the before tax cash flow of $266,000. You take that resale of $500,000, subtract out our adjusted basis. We know what adjusted basis is now. That's effectively what? Our purchase price minus our accumulated depreciation. Okay, is our adjusted basis. That gives us our capital gain. Apply the tax to that. So our after-tax cash flow from our owning would be $213,000. Now we look at it over here. If we sold it today, the resale price is only the $450,000, and we're going to have obviously same sort of calculations to give us what our after-tax cash flow would be affiliated with that. But the part that we're really getting most concerned with is this after-tax cash flow, the difference between selling and owning. So we're going to, first of all, look at the difference in terms of initial outlay, and this is really going to be predominantly focused on the ownership side. We're gonna have more of a capital outlay from owning than we are from leasing, okay? I mean, think about it from the standpoint, if you lease an asset, you don't really have much of a capital outlay at all. You have something that you may have, you know, in terms of some finish out you might have to pay, but for the most part, not nearly as much of a capital outflow with leasing versus owning. The part that matters, the big piece of this, in one sense, is what is the difference in operations? Well, if you remember, what I showed you earlier was that for each year, we have this difference that exists between owning versus leasing of $15,774. So that becomes a cash flow for us to be able to make the comparison between the two. Does that make sense?
Yeah.
You're looking at the incremental value or the marginal value of one versus the other, okay? All right. And as far as the after-tax cash flow here, this $185,373 is what we're using here, as you can see, for the initial investment. And that's assuming that we sold it today. Okay, so that 185, that's where that 185,000 is coming from. All right, and so what you're going to do, simply from a calculator perspective, is as follows. You're going to have one payment per year. You're going to have 185,373 as your initial cash flow, and then you're going to have, that's going to be a negative, and then you're going to have the 15,774 as a cash flow, and that is going to occur for really 14 times, because the final 15th year cash flow is going to include the reversion value, okay? Which in this case is $213,990.
I don't know that inject, that's the multiplier.
Yeah, what this is doing, this is simply saying this cash, it's right underneath the cash flow key, N sub J, which is just simply saying we're going to take that cash flow and it's going to occur 14 times. But instead of having to put this in 14 individual times, this allows us to shortcut the process. All right? Then that final cash flow, and then once we've done that, then we should be able to solve for the internal rate of return, and we should, if we've done it correctly, should match up to that 9.03. So just double check.
I get 8.75.
Did something wrong.
You got each seven five two?
No, I did right. Make sure you have one more per year.
Dr. Forget, you had the last,
One payment per year.
Yeah. Just, go over it.
Okay, shouldn't the 213,990 include the 15,774 for that year?
8.74.
Yeah, you would need to include,
Yeah,
I thought they were going ahead and adding it in there, but actually it needs to be, so they, whenever they put this there, they didn't do that correctly. There really should be another 15,774 right here to add to that reversion.
Oh, okay, good, that makes sense.
Okay, so if you do that, then it should match up to the 9.03.
Okay.
Good catch. Double check it myself.
Yep.
Okay.
Yes, sir. 103.
Okay, good. Always good when we can match.
Yeah.
All right. All right. So, then what they have done down here at the bottom is basically sort of shown effectively what they've done with the individual cash flows, which you don't really need to concern yourself with, but what the real number that we're really concerned with is this 9.03, and this is the return from owning. Now, let's explain what that number means and why it's relevant. Okay, if you remember from our discussions maybe, I don't know, a week or 2 weeks or so ago, and we were, talking about what are your other investment alternatives that may be available to you for, something in terms of marginal return kind of thing. I'm sorry?
The hurdle.
The hurdle rate, okay? This is kind of what this is really referring to, because basically what you're saying with this is if you have a hurdle rate, and I'm just, once again, pulling out of the sky a number of 15%. In other words, whatever you invest in, you need a 15% rate of return. By virtue of getting a 9.03 here, what is this saying to us? This is saying that is not a sufficient enough return to meet our hurdle rate, therefore we should lease. Yes, that's what this is telling us. But this is the return that we're getting basically from owning, okay? So if our hurdle rate is something greater than 15%, then only getting 9% return from actually making that investment in that piece of real estate, it really doesn't make sense for us to be investing in that real estate. We should only be basically leasing the asset by comparison.
But, sorry, let me
Because, okay, let me make sure I frame this correctly. There is no question that we have to make a bigger investment if we want to own something up front. We've got to pay in equity.
yeah, in this case it's 185.
Right. And there's no difference, and not the difference, but there's also the benefit that we receive when we sell the asset of some sort of reversion value that we don't get from leasing. So most of the time, believe it or not, most of the time, there is going to be a positive difference from owning rather than leasing. But the question is it enough, okay, to basically reward us for this additional outlay that we have had to make up here to actually purchase the asset? That's what this is really fundamentally predicated on, is what is that initial outlay and what return are we receiving off of that outlay. Now, if we had a much lower initial outlay or a much greater reversion, then yeah, this number would be inflated significantly to the point of where all of a sudden the deal makes sense. So that if we went back and we were to sort of say, all right,
Like 750 or something.
yeah, that the property value, today we could, or the resale value after year 15 was maybe 750,000. Let's just change that one piece and see what that does to us.
Just wanted to say, this is marginal.
Yes,
So,
yes,
So
yes.
it's like, obviously, when you own it, you're gonna have a higher internal rate of return, but since we're doing the comparison between if I were to own it, if I were
Yes.
to lease it, I'm looking at the difference. So you're saying that, like in this example, we're still below the hurdle rate, I'm gonna have a 12% rate of return, but if I have my alternative, which is 15%, then I'm better off to lease, free up that 185,000 of difference, and apply it somewhere else where I can get that 15% return.
Right.
So it's not, it's
Right.
marginal.
Yes, it is a marginal return. Yes. So in this case, if we inflate that resale price, you see it does increase substantially the.
That's a 500,000 a year change into 750,000.
Yes, that's all it did. Was change the 500,000 to 750,000. That increases the return on owning now to 12%. So still not enough of an incremental return to justify owning rather than leasing.
That don't make sense to tap the cash.
Right. Okay. All right. Everybody feel good with that? Yes, no,
Yeah.
possibly could be.
Yes.
Okay, so now the next phase of what we're going to do, real quickly, and then we're going to be done, okay, is to sort of take a look at a couple of little calculations that, and then we'll call it a day.
Can I ask one more quick question? This is based on interest only loan. If you had a full mortgage, I would have to put the remaining of that payment under my tabulation there and say, which will affect my revenue, right? And so where it says less mortgage balance, that's where I would put the amortized portion of the payment, right? Because this is like an interest-only, loan.
Yeah, that is true. You're gonna have equity buildup. Okay.
You would have to account for that at the house. For sad, right?
Okay, so let's assume that we've got, in this case, the after-tax cash flows from owning versus the after-tax cash flows from leasing, and then the difference. Okay, in terms of the initial outlay, let's assume that in this particular case, our on owning are $2 million, and from leasing, it's only going to be maybe 1.5 million. And once again, why would we have any expenditures here from leasing?
TI.
Tenant improvements, but also, once again, we're talking about this not just from a real estate point of view, but an operating business point of view.
Overhead, rent.
Right. Well, not sort of rent, but overhead and other ancillary sort of cost, okay? All right, so the difference between these two would be 500,000. Okay, an additional 500,000 from owning. Okay, so right with that?
Yeah.
Okay, and that's happening, let's say, at time period 0. Okay, then from years 1 to, let's say, year 15, we have, for owning, might be, let's say, 300,000. And then from leasing, let's say it's going to be 225,000. Okay, so the difference between those would be 75,000. Okay, and then the reversion during year 15. So I'm just going to put this. I guess we could, depending on how we want to. Well, we wouldn't leave that as 15, but we'll put another line item for 15 for the reversion. The reversion in the first instance is going to be, let's see, in this case from the leasing, we're not going to have any reversion, goose egg. Okay, and then from this one, let's say we'll have a reversion of $1 million. Okay, meaning the difference. Okay, now in terms of cash flows, first of all, and this kind of gets at your question, what is the actual after-tax cash flow internal rate of return from owning? What is the after-tax cash flow internal rate of return from leasing? And then what is effectively what we just calculated, the marginal internal rate of return from the difference between the two. Does that make sense? So 3 sets of calculations, all right? So the first one, all these are going to be 1 payment per year. Okay, so this first one will also go from left to right in terms of owning. So 200,000. And then,
No, that's
I'm sorry, 2 million.
Yeah.
My eyesight. Sorry about that. 2 million.
What is this right here you're doing?
This is going to be the after-tax internal rate of return from owning. Okay, and then 300,000. And that's gonna occur 14 times. And then the final cash flow is going to be 300,000 plus 1 million. Equal the final cash flow, and then solve for internal rate of return. Okay, we get an answer for that. Okay, then, so this is, once again, from owning. All right, then from leasing, 1 payment per year, 1.5 million. As our cash flow. And then 225,000 as the cash flows each year for 14 years. And then the final cash flow for the 15th year will be 225,000 plus the reversion, which is 0. So the final cash flow is just simply the 225,000. And then simply solve for internal rate of return. Return for that. So once again, this is from leasing. Okay. Then the final one, which is the one that we did on the spreadsheet, was just the difference, which is going to be 1 payment per year. $500,000. And 75,000. For 14 years. And the final year will be 75,000 plus 1 million. Was the final cash flow. And then solve for the internal rate of return. Okay, now. Okay, I got 13.845.
Wouldn't the leasing be a 15 engine since?
No, because
No, no,
I added
the one down below.
Yep.
You
No,
can go
well,
15.
you can.
You can go 15.
I was just trying to be
Yeah, yeah.
consistent.
Right.
Okay.
Yeah.
But technically.
Yes, you
Yeah,
can do
you can
15.
go 15.
Yes.
Yeah.
I was trying to avoid confusion by creating confusion. Okay, this one is 12.4.
At 14 or 15?
Well, either way, it's gonna be the same. It's,
Okay, yeah, because it's consistent.
right.
And there's no reversion.
Okay. This one,
What would be the title of this last one? The first one's owning, second one's leasing.
this one is effectively, this is the marginal return
Different.
from owning.
I don't know what's going on with
Be more specific.
Yeah.
I don't think it's immediate. I think it's one payment per year.
Yeah, yeah,
One payment per year.
Should be pretty plus minus for the first cash flow.
yeah. The percentage is plus minus.
I got 15%.
I got 16.8.
Yep, hold on, let me
Yeah.
double check. Whoa.
Yeah, 16.8.
500,000, plus or minus cash flow, 75,000, cash flow 14, 107. Cash flow. Yep, 16.8 million, sorry. I got interrupted there, the question, I think I didn't put the 14 as a J in there. Okay. All right, so, once again, this is the rate of return from owning, this is the rate of return from leasing, and that is the marginal return, additional return from owning versus leasing. So this is, the way to look at this is the return for owning versus leasing.
Can I ask you, just it's more like a mathematical thing, like, you know, that's how we get the error rate. But if we take that 3.84 and we subtract it by 12.40 and then divide it by another 12.4, shouldn't we have the same percentage rate that we get with there as the marginal difference?
I'd have to think about that a little bit, but it's possible.
I know how I got the answer, but explain the 16.8.
Okay, this is precisely what was done in the spreadsheet, the one that we put up on the board, which is nothing more, in other words, the spreadsheet did not do either of those calculations over there, okay? This is simply saying, what is the marginal benefit of owning the asset over leasing the asset?
So the difference between the 13 and
These are, to a certain extent, these are almost irrelevant. It's just that this is, I mean, yes, independent of each other, this is effectively the return from owning, this is the return from leasing, but what really matters is what is going to be the difference between the two of them of owning above and beyond the leasing. What is the marginal benefit or the marginal return from the actual ownership?
so that $500,000 difference
It's saying,
is in essence.
basically saying that over here, yeah, we are potentially having to invest more, but hopefully after everything is said and done, will we get a better return on that money than we would have gotten just from leasing the asset?
So the return on the difference is 16.
Right. Okay. All right, any other questions? Okay.
Just curious about the initial outflow of the 1.5 million for lease. What are you identifying there?
Okay, this is what I was saying earlier. This is not really from, in other words, the thing that you cannot do with this, don't try to make this all about the real estate. This is about an operating business. And so these cash flows that are occurring here from the leasing alternative are not really real estate related. They may be from the operational side of the business. In other words, you've got equipment that you've got to pay for to operate this business. You've got, other things that you're finish out that you may have to do, to create this business, to get it up off the ground. Those are the costs that are embedded within that. Okay? So that's what I'm saying. It's not, because if you notice that the pro forma that you're given, like in that spreadsheet, is not a real estate pro forma. It's a business pro forma, an operational pro forma. Okay? And so that's why this analysis, all you're trying to, the whole reason they do this is to try to take into consideration the other variables that are going to come into play beyond just the business or beyond just the real estate component. Okay? All right. Okay. With that, we're done. We'll see you next week. Next week, we'll finish up some of the lecture on the corporate real estate stuff, and then after that, we'll have a quiz on the corporate real estate stuff. And then the following week is when we'll have the actual test number 2 that will cover these latest 2 chapters, okay? But next week is just strictly finishing up the lecture on this, and then the quiz on this material. Yep.
you
No, man, it's just Memorial Day, you weren't here. And I went here today. The walk on that shit.
Do the power board?
Yeah.
Okay.
When you're talking about this class, land use, this same class, next semester, right? GTS.
Finally meet you.
You the other friend.
I'm the other friend.
Okay, you the,
Jacksonville, right?
Yeah.
Do ball too. Okay. Finally to meet you. I'm like, who is this imposter? You're not in the Oh yeah, I moved here like 10 years ago.
Oh, okay. Yeah, we just got here. Yeah, we moved here.
Eddie from Jackson. I'm like, what?
I hear your name, so yeah.
How much longer you got?
Probably like 4 months.
And fall starting in August.
That's the last day.
It's been a ride, man.
Oh, man, what you do? We didn't, just call me so I can.
You and I come with any of those classes.
Oh, yeah.
So we got you.
You got there's 2 of y'all. Oh, that's right. 904.
Check those out.
945.
You had to change your number.
I didn't want to change my license. They made me do it. I didn't want to change my license plate. I
There you go, man. There you go.
didn't want to change it.
Put you down as pregnant too.
Okay.
Put you down as synthetic French.
Oh no! You got an E after your D?
The F-R-E-D-E-R-S-K.
Oh, see, we different. I got R-I-C.
Okay, then, my friend.
Right here.
Okay, I'll get you up, man.
Synthetic.
Not really.
85 minutes.
85 minutes.
That's a lot for 4 questions.
Yeah.
That's 20 minutes per question. That's absolutely nice. That's an average over years. So
Are
that's
they 3-part questions?
huh?
Are they 3